Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. Our next topic is long options. I am your host, Kevin Horner. Thanks for joining me today, everybody. Stepping in for our friend Brent Moores. We're going to talk about the utilization of long options today. I'm going to give you a couple of examples where traders who are maybe thinking about using long options for speculation strategies, which certainly is a popular approach to long options, but also one known as a synthetic equity position, whereby the trader might own a long option, a long call option, for example, as a means of simply controlling 100 shares of the underlying stock. We'll talk about the makeup of that, the components of that, some considerations that traders would like to keep in mind when they're working through this thought process. So we're going to talk about a number of those things today, but in doing so, I am joined today by my friend Connie Hill in the chat. She, of course, is a busy mouse today. Connie will be there to answer questions that I'm unable to get to for you, but I do want to hear from you. So you can certainly post those in the chat for the duration of the show. We'll go about 45 minutes in total. Of course, if you're not already doing so, we would appreciate a follow on X. Connie's available, Connie Hill CS, and I am Kevin Horner CS there on X. We try to post for you there throughout the week. I'm a big believer in posting individual equity charts where we come across notable price levels or new trends that are developing. Those are intriguing to many traders. And that's what you're going to find from me there on X as well. So follow us there. And of course, if you're not already doing so, make sure you are subscribed to the Schwab YouTube coaching channel. All right, let's get to some disclosures, and then we'll dive right on into things, everybody. So first and foremost, remember that our discussions here are exclusively for your information and your education. We do not make recommendations. We do not endorse a specific approach to trading the market here either. Now, today, when we are covering long options, there are some components about short options that you may not need to be aware of, everybody, but that doesn't mean we shouldn't cover it. So first of all, remember that options carry a higher level of risk and are not suitable for all traders. In order to trade options at Schwab, we ask you to be approved on each individual account in which you would like to trade options, everybody, and be familiar with the characteristics and risks of standardized options. Which is a document that we can send to you. You can also get from us at any point. Now, we work in a paper money version of our thinkorswim desktop application. And like I said, today we're talking long options. But for those of you utilizing paper money to sell options, recognize that you will never get an early assignment on a short option transaction in paper money. However, this can happen in live accounts anytime. In fact, anytime you are short an option, you are at risk to have an obligation to either buy stock or deliver stock. And this can occur even if your contract is out the money and can occur early as well. So anytime in advance of option expiration. So please be aware of that risk. It is something we all need to be aware of relative to being a seller of options. And so today's class is going to focus, as I noted, exclusively on long options. And I thought a quick look at the S&P here, just as a level-setting idea as to where we are in the market, would be a good, helpful reminder. Yes, we've got upside. Yes, we've been rallying the S&P 500 quite nicely, holding the 20-day moving average in orange along the way. But recently, we have broken to new highs, and in so doing, changed our moving averages a little bit. Check this out, everybody. I'm going to shift from, and actually what I'm going to do is make a change here. From my 200, I'm going to make a 10-day, and I'm just going to make this one stand out a little bit. It's going to be white. So I'm going to move this up the ladder a little bit. Check this out. We have actually been holding the 10-day moving average now on a closing basis all the way back to June 23rd. Now, I've talked quite a bit about us holding the 20-day moving average for what today I believe is like day 67. 67 consecutive closes over the 20-day is great. But here we're looking at a wonderful move over the 10-day moving average now at 26 calendar days, holding not calendar, excuse me, 26 trading sessions holding the 10-day moving average with a return of better than 6.25%. So that seems interesting to trend traders as well. And the reason that trend traders might pay attention to these things, everybody, is that a move like this can be signaling us that there is more momentum than we might expect. And how would we expect to see a shift in momentum? Well, the first thing that a trader would look for is something new. First could be a close below the 10-day in white. That could be a reason for a trader to take some off, as could a close below the 20-day. Okay. Now, if you're that trader and you're thinking about, hey, maybe there's some weakness in the S&P, where could I find opportunities for bearishness? Well, that's one of the reasons we're going to talk about a couple of positions here today. I found a bear scenario on a chart in Intuitive Surgical here today, everybody. I thought we could look at this. Now, that line appears to be a little bit out of character. So let's pay attention to what's been going on most recently here. We clearly have a stock that had been wonderfully upward moving here along that 50-day moving average. And then things got quite squirrely here back in March. And this was an interesting scenario because, as you can see, the stock broke down through the 50-day moving average with conviction early March. Now, there was not an earnings announcement, so this was something alternative to that. This was something that was perhaps news-driven or potentially, as I don't recall exactly what was going on in March, but the potential exists that it was something out of the administration relative to healthcare costs and so forth. It could certainly have had an impact here. But the most important factor I would suggest is how the stock was working against that beautiful 50-day moving average all along the way until suddenly it wasn't. And so that breakdown, it seems notable, right? Broke down. Yes, we rallied back, but if you'll make note of the fact that we've traded up to this downtrend line a few different times and failed, well, each of those times we traded to that downtrend, it has resulted in lower lows thereafter. And that's what we're in the midst of right here. So let's hide that 10-day moving average real quick. All right. So what I was paying attention to here, everybody, was this big, huge candle with the earnings announcement, right? Stock had tried to get higher into that 530 zone, and it did not work out. In fact, we see that we met some resistance here. This was a prior peak here, and then prior peak there as well with the highs just a couple days ago, and the downsloping now 50-day moving average. So this could be a development where a trader who's maybe late to the game, who has not been necessarily taking advantage of bearish trades here and here and here, but is wondering, hey, maybe there's something developing here. The fact is we've traded through the most recent lows, right? And now we have rallied back in. So let's zoom in on just what's been going on over the last couple of months here. And many of you traders are probably thinking the same thing that I was when you look at this. Does this look a bit like a bearish flag situation? And some would say, yes, absolutely. So here's the flag pole that I was looking at as a potential pattern. And then the cloth portion of the flag, we would note, is making higher lows in the short term, but also not making any higher highs yet, right? So in order for a lot of traders, in order for this to kind of not develop bearishly, traders would want to see this moving through about 505 to the upside, right? So at 505, if we traded above, then traders would say, well, it could still be bearish, but there's maybe a better likelihood of more of a rally in the short run than a continuation breakdown maneuver, which is what we might be in the midst of seeing right here. Now, if you looked at this and said, I am bearish on this due to the breakdown, how could a trader validate prices that would make sense for a possible long option trade? Well, we might take the height of our flagpole. I'm just going to activate it, and then I'm just going to put it to here. Now, you got a couple of ways, We want to talk about this briefly, everybody. A couple of ways that a trader might assign value, price levels to which the stock could fall if bearishness were going to persist here. One way would be to maybe draw that line from the highest high after the selling, right? And that might be this high trade right here on day 2 of the selling. And an alternative to that, and by the way, that means the level comes in around what, 462 or so? The alternative to that might be to throw that line at the downtrend line, basically saying, all right, if we broke the downtrend line, now I'm expecting a move equal to the height of the flagpole. And that might be about 456. Now, that's about a $6 difference. Not a huge difference, right? But I'll remind you that when we look back in time, we could find some other levels that might hold up and make be a spot where some of the selling might lose steam. And the level that stands out on this chart is just the last low, right around that 464, 465 area. Okay, so that could give traders a way to maybe target this potential bearish scenario. So what are some of the things that stand out on this chart to encourage traders to give thought to a possible bearish trade, that is to say long puts on ISRG? First is the fact that we've got lower highs for quite a while, right? Lower highs along the way. We did have support held in here at that 505. I'm going to make that red, but we're now below it, and we're below it for 1, 2, 3, 4 sessions, right? Now, if you're a trader waiting for confirmation of a breakdown, well, 4 days consecutively below what you deemed previously to be support could be that validation for some traders. Not all traders, but some traders. Reminder, it's our job as traders to define our viewpoint of confirmation. Is it that you trade immediately based on a breakdown? You take that trade right away? Do you wait for 2 days, 3 days of confirmation? What is confirmation for you? Once you've got it defined, then it should make our decision making substantially easier, right? So if we're looking at this today and the trader feels that there is in fact a bearish opportunity, well, we have a couple of additional things to note. Since we're past earnings, any bearishness we have, we could carry for more than a couple of weeks if we wanted to, right? Because we're not likely to have, or we don't have an earnings announcement to worry about. That doesn't mean we couldn't get other news stories that could be impactful on price, but it eliminates one key window of time, that being the earnings window. So if we're traders anticipating more weakness, we could work from that 505 zone. We're probably going to want to think about a trade that has a delta that is higher than, say, 50% or 50 cents. Let's look at our trade tab here on ISRG. And I'm just going to close the series just quickly to see where I have the most opportunity for volatility. Well, we're not going to get a whole lot of it because, as I mentioned, we are past the most recent earnings. So we've got another 10 solid weeks before we're going to see earnings come into play. So any of these available series are likely to be similar in price and give us an opportunity for the trade that we're looking for. So define your window of time. We're going to go out to about August 15. That's going to give us 2.5 weeks to see if this bearishness can persist in ISRG. Now, when I was mentioning the delta, everybody, let's shrink this up a little bit. I've got too many in here. So let's do 14 instead. All right. So here we've got delta in my delta column. And the 505, which is what we've kind of pegged as potential resistance, has a delta of 55 cents. That tells us that for a $1 drop in ISRG, this 505 put could be expected to pick up 55 cents per contract. So maybe the 1290 bid we see would move up to 1340 approximately, right? Something like that. And that's all the delta is going to give us is an approximation. Let's not get too fine in our viewpoint. So 55 cents the approximate move in the underlying in the contract relative to a $1 move in the underlying stock. It's also the likelihood potentially of this contract being in the money at expiration. So the 505 contract has a 55% likelihood of being in the money at expiration, but that does not mean that the value 13 by 14 bid versus ask, that doesn't mean you can expect that value to maintain, okay? Those are two different concepts altogether. So the trader who wants a higher probability of the contract being in the money at expiration can go higher in strike, and in so doing will get more bang for their buck in a $1 move in the underlying stock, okay? So here, that 515 is going to be costly. It's going to be about a $2,000 position to speculate that there's more downside to be had in this trade, right? And as a $2,000 position, in order to get that value from this contract, your break even, if you bought this contract for $20, our break even would be $20 below 515. So that would be 495, and that would be at expiration, right? At expiration Friday on this contract, August 15, if the stock were under 495 and we paid $20 for it, then we would be breaking even on our trade. Any movement under 495 as of expiration would absolutely bring us a bit of a profit in this scenario. And of course, if it trades under 495 earlier than expiration Friday, well, then we have additional value, right? We've got time value built into the contract, and we might be able to sell it for even more than 20. Hence our desire maybe to take this position at this time. Okay, so let's go ahead and put on an example trade utilizing this contract. And I think we're going to go with the 515, give it a couple of weeks, and see if this moves in our direction. And I'd wanted to give the reminder that maybe we get down to that 560 or 465, and from where we are, that would be a $35 move. So if that were to occur, and I always think it's helpful to consider the theoretical pricing tool here, everybody. Make sure your dates line up, okay? But if the stock were to fall by that 35 points, well, then we have an estimation of how this contract might look. We might be buying it for $20 a contract, but if by some chance it finished today at 465, this contract could jump up to $50. Okay, that's the Theo value right here. Now, if I change the dates, let's go forward to Friday of this week. Okay, so today's the 29th. Friday is August 1. And then look at now that contract that look at that. Okay, so it's held up. That tells us that the 515 and the theoretical price, even if it made this move at any time this week, we could easily see a significant jump in the value of our put contract, right? Because obviously deep in the money would be fantastic on a long position, a long put like this. So if we were targeting that, this gives you a way to say, you know, if I bought it at 19 and a half, but it drops to a level I think it can get to, it would allow you to say, all right, I'm going to put a limit order out there to sell this contract as the stock is falling. If I can get out at say 40 or 45 a contract, right? If you were able to quickly double your premium here, that would be one way that a trader might look to do it. So let's go ahead and put this on. I'm going to right click here and do a buy single. There we go. And we are now showing bid at 2030, offered at 22. So we want to go in between them to the mid at least. So let's give it, let's try and get in there for 20. Let's see if we can get in at $20 even today. Let's go ahead and double check. All right, so the maximum we can lose on the long put is just the amount we put into the trade, of course, unless by some chance we were the owner of the put contract and we put ourselves in a rough spot. And remember, if we don't own the stock, everybody, and you are long the put, it is our job to, as the long owner, to exit that position before expiration Friday to avoid any possibility of option exercise, which can occur even on the long contract if your contract is in the money on expiration Friday. So it is important to keep that in mind. All right, so we'll send that off. All right, it did buy it for us right away. And in fact, we got a better price, everybody. We put in a limit at 20 and we got filled at 1985. Okay, so that gives us something to check out on the long put side of things. And I wanted to make sure because we commonly will have discussions around call options very frequently in such a class, but I wanted to make sure we talked about a put here this morning. I saw a question in the chat today about leap options and some considerations there, and I definitely wanted to talk about that a little bit. Now, the reason I want to talk about it is the idea of what long call options can do for the trader. Let's look at a stock that some of you might be familiar with, Mercado Libre. Now, what's notable about this, everybody, is the price per share at which this stock trades. Look at that, $23.71 a share. That's not exactly cheap, right? So it's pricey for traders to buy 100 shares of this stock. That would be a $237,000 position to own 100 shares of stock. So what is one of the reasons that a trader might incorporate call options? Well, we might refer to it as a synthetic long stock position. In such a case, everybody, instead of, by the way, let me highlight this for you. Let's show you how that looks. Do order entry on, I'm going to do this with a right click in here. Buy 100 shares. Got 100 in there? I sure do. Okay. Buying 100 shares, 253, almost 254,000 for the trade, right? It's a big chunk of change. Not everybody's got that availability. And I just want to remind you that while we're talking about a high dollar stock here, that doesn't mean the process and the concepts can't apply to lower dollar stocks. Remember, some of us are working with position sizes that are much smaller or trades that are smaller. And even if your stock is a $20 stock, you might look at it and say, yeah, $2,000 is too much for me to own 100 shares. So think about this process we're going to explore now. So we're going to look using MELI. We're going to use this as our example, but we're going to look at contracts that go out the money quite a ways, and these leaps, all right? So long-term equity anticipation contracts is ultimately what they are referenced as. We're going to go into the trade tab, and we're going to go and look out how far are we talking here? Well, we can go to January of this next year, a little less than 6 months, but let's go to January of next year, which is more like 18 months of time frame, all right? And so a trader might suggest that they want to own the 100 shares of stock, but they're comfortable putting a finite window of time on the trade, right? And that's what we're looking at right here. Now I'm going to change my menu so that I can find delta, gamma, theta, etc., and recognize once more when I'm looking at delta, if I want a synthetic long, that is to say, I want essentially the equivalent of owning 100 shares, well, then I need a delta that is going to basically be $1, right? I want something that's going to be dollar for dollar movement in the underlying stock. Now, that means I need to get more strike prices here, right? So let's just kick this up to 40 strike prices. And I find that even if I bought this 20, let's go a little higher, go to 50 contracts here, everybody. All right, the 2100 call is still a delta of only 74 cents. Now, the reason for this, everybody, is all tied to time, right? So because we are all tied to the time frame, we can't get a delta without going much, much deeper in the money. We cannot get that delta higher than that 74 cents on the dollar, right? If we went to January of next year and looked at that same 2100, check this out. Same 2100 for January of this year, much cheaper. No, look at that. I'm wrong. We've got the delta here at 75 cents too. So we're going to get the same dollar for dollar movement in a contract with 170 days to expiration, costing us $424, right? And for the record, that's the equivalent of a $42,000 position. We're going to get the same dollar for dollar movement in this contract as we would in one with an extra year. Now, we have to pay more for it, but I suppose the best question to ask oneself is, which matters more? Do I want that extra year of time, or do I want the more affordable contract? $42,000 contract versus, say, $62,000 contract, okay? Now, again, none of these are small in value, but they are small in value relative to what it would be for the underlying stock, okay? So the answer, I think, to the question here that was offered up earlier on about, looks like it's, I'm going to butcher that one. It looks like it could be tart applesauce, maybe. The idea could be utilizing a leap for the sole purpose of reducing cost to get exposure to the underlying stock equal to what it would be if you owned 100 shares. But you're getting to do it for a lot less, right? So that's one of the reasons that a trader might incorporate something like this. Again, stock replacement is what you might call it, or a synthetic long position. But incorporating delta and giving consideration to whether it makes sense to do it at any given moment, obviously, in bringing into light some standard horizontal support, for example, which some traders would draw in, based on this maneuver. This looks like an area that some would define as support over 2,300. It might make sense to be a trader at this point. Not everybody would, because we're under a 20-day moving average. We're beneath a 50-day moving average. We are testing horizontal support. So that kind of might validate a trader ready to take a position here. But buying 100 shares is going to be a lot more expensive than buying a call option, even a call option that's going to work dollar for dollar, right? So in some cases, the trader would look at this and say, yeah, I don't even want to go out that far. I don't want to go to January. I only want to trade for the next 2-3 months. And they can find a delta that's going to be a lot higher, right? And that higher delta is going to get you a closer equivalence to the underlying movement in the price of the stock, right? And that's ultimately what what some traders would think of with long option. And the trouble right now, and I say trouble, it's not really a trouble, but it's a need that we traders have, and that is to understand that right now we are going to be coming across a lot of individual stocks with earnings coming up. And that means we need to be watching implied volatility because stocks that are approaching earnings windows are apt to see elevations to implied volatility. And that absolutely will have a hindrance on your cost. It'll increase your cost. Now, that can work okay when you're talking about spreads, right? Because you might buy, if you want to speculate on upside, you can buy a call and sell a higher strike call, capping your upside, but reducing your cost. But with a long option that doesn't incorporate a second leg, well, you're essentially putting at risk the dollars that it cost you to buy the contract, calls or puts, okay? So one of the things to keep in mind, all right? Now, I do have a couple of positions for potential considerations as examples of how long traders or a trader of a bullish scenario might look. things they might consider. Let's take a look at D.R. Horton. Now, D.R. Horton, I got to change my study details here, everybody. I'm going to just add back my 20, my 50, my 200. Now, see, D.R. Horton has already gone through earnings. And that's why this one might make sense, because if I put that implied volatility back in, looks like I got rid of it somehow. There we go. All right. So implied volatility, look where that is, everybody. Nice and low. In fact, look at where it is now relative to the lowest it has been. So what do we know about implied volatility? It's simply telling us that contracts in options in D.R. Horton aggregately, calls and puts aggregately are lower in price. They're not juiced up, so to speak, by volatility. That means that the buyer of the contract can justify doing so because they're not paying an exorbitant amount for. There's not a huge expectation. Doesn't mean the stock can't move. Just means there's not a huge expectation of volatility. Now, why did this come out for me today? Well, a couple of key components. Many traders will point to that IV and say that's a positive for the long option trader. From the technical aspect, we had a breakout that took it from support at the 20-day to new short-term highs. So we have resistance at the level that we rallied to. So that's one spot. But we also note that we are about to see the 20 crossing the 200-day moving average to the upside. And on the low of the day, we happen to test the 200-day moving average. And a lot of traders would say, look, we've broken what was a downtrend, depending on how you choose to draw it. You can draw it like this and either capture that top, and you could say, all right, this is a potential breakout. But some traders would point to the fact that we are above the 200 and have traded through on the upside, closed above the high of the low day in this pullback. If the low day in this pullback was Friday, well, yesterday we closed above the high trade from Friday. So that might be the resumption of a short-term uptrend here. Okay. So if you were bullish in nature, some traders might look at this as their opportunity. And again, the question becomes, how much risk is the trader looking to take on? The trader who says, I believe that there is upside here. I believe that resistance at the last peak is not apt to maintain, meaning the trader thinks it's going to move through 152. Well, then you can certainly utilize contracts further out, higher in price. But anytime that you buy contracts out the money, well, now your risk factors are all tied to price action, because every dollar of value in contracts that are out the money, we're going to tighten this spread, these numbers of contracts up. So we're trading at just shy of 147. Anything over 147 is considered out the money, and thus all of that value is time value, right? Look at the delta here, everybody. Sure, you could take the 152.50 contract. It would be affordable for the trader, much more affordable at $1.75, $1.70 versus, say, buying the one that's in the money, which would cost almost $5. But look at the difference in the likelihood of value at expiration. A delta of 60 cents on the 145, but on the 152.50, a delta that's half of that. So we're looking at a contract that has only 30% likelihood of even being in the money at expiration. Okay? So this is one way that a trader will balance the thought process. And I believe that the majority of new traders in options, specifically long options, buying calls, buying puts, typically the new trader says, I want to spend fewer dollars, but they don't give consideration to the delta and what it implies. A lower delta tells us that we have a less likelihood of the trade playing out in our favor. Okay. And this is why a trader must grow comfortable with the idea of higher delta and higher priced contracts in order to benefit from the price action that might come. Now, I'm going to ask you all a question. How many of you are trading options already and have put yourself in a scenario where you have bought a contract expecting the price of its price to rise commensurate with a move in the underlying stock, only to see that the move in the stock occurred, but the value of your put or the value of your long call didn't go as high or didn't move as much as you would have expected? Well, that is that function of A, delta, and B, implied volatility. So, Fran, I think a good way to gauge the expensive or cheap nature of options is to incorporate something like the implied volatility here and recognize that implied volatility isn't really paying attention so much to the value of volatility, but rather its relationship to prior instances of volatility. Notice how we had a big spike here in April. That wasn't because of the underlying stock going to expirate or going to earnings. That was because of all the concern around the tariffs and the market pulling back aggressively at that time. That led to a massive spike because of uncertainty in price. So when that uncertainty in price was borne out, value of options went through the roof because traders had no way to validate where we knew or felt price could really move to, right? So this is one way to give consideration. Am I paying prices that are affordable relative to historical price action, or am I paying expensive prices? And back here in April, if you were the buyer of options, you were paying a healthier premium than normal. And today, it could be stated that you are buying, at least as it relates to DR Horton, you might be buying contracts or selling contracts at depressed values relative to historical. Okay, I hope that helps out. So here with DR, as a trader if a trader were to believe that there is more upside and the opportunity exists to break out and give another layer of upside, everybody, you might just duplicate this line and look to the level from which it fell last. And that was these double tops back here in November of last year. And that level's just shy of around let's just call it 175. All right. And so that can give the trader, kind of a target idea. So you could think about two choices, I suppose, utilizing this opportunity. The trader could maybe buy a contract that would be somewhere over 140 in strike, being that the 200-day moving average is right there at 140. So you could buy a 140 contract for a couple of weeks. The alternative might be, hey, picking a price that you like, say the 153. Maybe that means the 155 strike price becomes important for the trader. Because if you trade through the 153 zone here, maybe the trader thinks that there's upside to that 175 zone, right? That 153 breaks. Selection one, might be to be a buyer of a contract in the neighborhood of the 140 strike price in here, right? or to be a buyer when the stock breaks through 153 to the upside. Okay, that might make sense for a trader with wanting more confirmation. All right, everybody, it looks like you got me back now. So I want to lay out the two options for you, okay? One scenario has us simply buying contracts based on the 200-day moving average for a couple of weeks, high delta, 77 cents. So if the stock moves upward quickly or moves upward during the life of this contract, we can do that. We can be all right with our trade, right? It cost us about $8 a contract to make that purchase. Alternatively, we could say we're going to be patient and we are going to buy the 155 contract, but only if the stock is through the 153 level. So the way that might be done would be to incorporate the gear icon here, and we could do it like this. Now, one thing we need to be aware of is that our order, we would need to be very specific, right? And chances are we would want to incorporate a limit price, all right? But some traders might just look at this and say, well, if DHI is mark, so last trade, is greater than or equal to, let's call it 154 to give it a little bit of, we would like to see a move through that level, right? We set 153 as resistance, but we could say a close or a trade over 154 would encourage us to put the trade on. Then we could do a limit purchase of our call option at a specific price, okay? Now, this is where it could get a little tricky. You know, we, the trader, might have to get an understanding of where that price could be, right? So if we go back to our theoretical tool and we suggest that we get that movement, so let's say we would have to go up by $8, let's say $7.50, okay? Because that would put us at 154. So we'll go up $7.50, just shy of 154, as you can see. Then, and if it did that by Friday, what would our 155 call move from? Well, it would, instead of $1 by $1.15, we would see it at about a theoretical $3.20. So that might give us a range for consideration. So the idea might be, let us place the order to buy at a limit of $3 if and only if we can get DHI to be above 154. Okay. Now, you could assign time to that. You don't have to. This just says, hey, if at any time we see DHI above 154, place a buy of one contract with a limit at $3, good for the day. Okay. That's what that suggests. We'd save that, and then we would go ahead and hit confirm and send. Notice here my order conditions are definitively noted here in my chart, or rather in my order confirmation, excuse me. And then I will send that off. Now, of course, we're not going to get execution on that one because we need DHI to be over our level. But the only other reminder is that you could have made that a good till canceled order to make your purchase, which would give you in more than the current day. But I think a lot of traders would like the opportunity to revisit the trade after market close rather than keeping it open for multiple days down the road, especially if you're waiting on a breakout. So hopefully that was a little bit helpful, everybody. I know that kind of got a little deep if you will, looking at the analysis of the pattern and the way that a trader might be patient as opposed to buying an in-the-money contract right now. Maybe they want to buy an at-the-money or close to the money on the breakout exclusively. That could make some sense for many a trader too. So I want to thank you for being here today, everybody. Appreciate you sticking with me through my difficulties, my technical issues. I'm not sure what went on, but I'm glad we got through it. So thanks for sticking with me. Thanks to Connie Hill in the chat and keeping you all apprised of what's going on my end of things. But I'm happy to address your questions. I really appreciate y'all joining. Make sure you're following Connie and me on X, Connie Hill CS, Kevin Horner CS, and of course, if you like the discussion, hit that thumbs up button for me. We'll get this conversation updated and archived and into the YouTube channel for you as soon as possible. So hope you all have a great rest of your Tuesday, everybody. Look forward to seeing you again real soon.